Hi traders, welcome to part 3 of our Q3 performance video. Here we're going to be looking at step 3. So step 3 out of building a sustainable, scalable, reproducible strategy. And we're going to be exploring how did we actually build these strategies to give us this 73.04% up in this Q3 performance so far. This and more in this video. Hi traders, thank you for joining the MasterTheMarkets team in our Q3 performance report video today and supporting us in our mission to spread the truth of trading and help you achieve consistent performance. It is still Naupan here, founder of MasterTheMarkets Elite Trades Conference and Traders Open Day. So traders, here we are on the part 3 of this 3-part performance video series in looking at the 3 steps to building a sustainable, scalable, reproducible strategy. Okay, this is part 3. We looked at the first 2 steps in the previous videos. If you haven't watched them, I highly recommend you guys to go and watch them, and also go on to our Trader Starter Pack 5-day video course as well, which has been designed over 12 years of collected research taught by institutional quant traders. Okay, you'll find the link somewhere in this video. Go register for it. It's for free and it's designed for both beginner and intermediate traders. Highly recommend it. Now, in terms of the 3 steps, we looked at the last 2 steps in the last 2 videos. The third step, let me go on to the third step for building a sustainable, scalable, reproducible strategy, like what we have designed to produce this monster returns so far, which is 73% so far this year. The third step is basically your power rewards, okay? Power rewards. Now, what do I mean by power rewards? Now, before you get to, some of you may start to switch off. Oh, Thiru, are you going to talk about expected, reward to risk ratio? Okay. Now, one misnomer that I must get you attention is more than paying attention to expected reward to risk ratio. More importantly, you should be looking at actual reward to risk ratio. Okay, actual reward to risk ratio. There's a big difference. For a large amount of time, even in our journey, we were always focusing on this expected. We were always looking at strategies which you always hear, like 3-to-1 reward to risk ratio and 2-to-1. Make it more asymmetric is another word that they use as well. Now, as you and I know, traders, some of you have been trading for quite some time. You and I will know that, if you're talking about expected from your point of entry, let's say your entry is here, and let's say your stop loss is about here, right? So all that is all fine, but your target, you can place it anywhere you want. You can even place it here, you can even place it here, and then you can make it look like, okay, yeah, I'm taking strategies which are 7-to-1, 10-to-1. But the question is, will it even ever get there? Or does it get there and then come back down and then you end up with much lesser profits? How do you tackle all those questions in your mind? This is why the first thing you must really understand is don't look at expected reward to risk ratio. You look at actual. Okay, look at actual. Now, what do I mean by that? Sometimes you see traders, for example, our strategy here, right? Our strategy here, which is the 1-day exit strategy here. Now, this has actually got a very low reward to risk ratio. Okay, if you're talking about expected reward to risk ratio, we only take it at 0.5% profit to 2% risk. So we're actually taking in terms of 1 to 4. Okay, reward. In fact, in terms of reward to risk ratio. So basically, we are taking only 0.25 to 1. Okay, only 1/4 is the profit. Now, some of you might exclaim and say, dude, what kind of a strategy is that? Why are you just doing 0.25 to 1? Remember, hold on and just listen to this, right? This is called expected. Okay, now think about this. If I'm entering here and my stop loss, let's say, is a bit much more further down here. So this is the amount that I am risking, okay, right? Let's say, and that is in the Dow Jones, let's say that is about 150 points I'm risking. And in relation to 150 points, let's say now divided by 4, what would that be? About 37 points, isn't it? So 37 points, I'm only going to take a profit from, okay? So this is my profit. So you can see that expected wise, my profit is only 37, but my risk is 150. And that's what this strategy is all about, right? So if you explain why do such a thing, right? That's called expected. But see what happens in real time. If you look at our stats over here, let me show you the stats for that strategy. So if you take a look at that strategy here, 1-day exit strategy over here, so you see overall, you can see that the total profits is made over 119 trades is 75% reliability. And the total profit is 45, it gave back 21. Overall net profit is 23.34%. Now, look at the profits, right? Even though my expected is 0.25 to 1, pay attention to this, is expected. But look at my real. My real is 0.5 profit, I get 0.5%, but my average loss is only 0.75 actual. So in fact, my average profit to average loss becomes 0.67%, 0.67%, okay? 0.67 to 1. Every time I risk 1%, I can get 0.67% win. And I can do that 75, 76% of the time. So therefore, overall becoming a net profit strategy. Some of you may still be saying, so now hopefully I hope you appreciate the difference between expected and actual. So some of you may then be saying, okay, why do I then still have to place my loss, my stop loss so much away? Why can't I put more tight and make the expected even better? And the reason for that is, traders, sometimes the trade needs movement. It needs a bit of space, leg room to move. So the next bar, if it opens, if it just does that and its tail is quite big, and if you put your stop loss too tight, it can kick you out before getting to your target. So you will end up with more realized losses. So that's why it's very, very important to always know your expected and your actual. Mostly I pay attention nowadays to more actual reward to risk ratio, which is more this number over here, which is 0.672. 1. So hopefully you can understand and appreciate. To know all of that, you must follow part 2 where we build the parameters quite strongly so that they're sustainable, scalable, and reproducible. Okay, so watch part 2 of this 3-part video series on 3 steps to building a sustainable, scalable, reproducible strategy. Okay, so that's the thing I wanted to impart to you today in terms of that. But you can see the other two strategies, they are quite asymmetric reward risk strategies, 3.51, 2.73 in actual time, in real time as well. Okay, that's how we have achieved this 73.04% in September. Okay, Q3 performance is what we are looking for. That is over here in September so far. Okay, 1% being 1,000, that would be 73,040 pounds. Now, some of you may say, okay, still, Tiru, why do I want to still do a strategy which is a low reward to risk? And the reason for that is, in our previous videos in Q2 performance, we talked about it. The reason why we combine these kind of strategies together is so that our peak to valley drawdown becomes small and smooth. Okay, that's why we do that. And we teach all of that. Also, the best place for you to start is Traders Starter Pack, the 5-day video course to understand all these principles on how to build it. It teaches in a very systematic, methodological way, and it's all for free as well. And we teach all of this also on our Traders Basecamp package as well. Okay. So there you go, traders. So you got the 3 parts now to building a sustainable, scalable, reproducible strategy that will give you a rough idea on how we are achieving this incredible, consistent returns as well so far on our Q3 performance. So just as a recap, what are the 3 steps to building a sustainable, reproducible, scalable, reproducible strategy? Which is number 1, we looked at was CO, which means concept and objective. Number 2, the power parameters. Now there are 3 power parameters that we talked about in the second part of this 3-part video series. I encourage you to go and look at that as well if you haven't. And now the third step to building a sustainable, scalable, reproducible strategy is your power rewards. Okay, traders, I guess that's pretty much it. Just a quick reminder, if you haven't yet, definitely go and watch Trader Starter Pack 5-day video course, 12 years of collated research for both beginner and intermediate traders taught to us by institutional quant traders. All right, traders, that's all from me on this video series. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.